Welcome everyone to the Keeping Your Business Together in a Crisis live stream webinar series. This is part 12, Understanding Your Cash Flow. This series is produced by the Boulder Small Business Development Center to support businesses in Boulder County, as well as the rest of the state through our TechSource program. We are one of 15 SBDCs in Colorado, and so if you're dialing in from somewhere else in the state outside of Boulder County, just go ahead and go to coloradosbdc.org. And you can find the closest center to you to get help with consulting that's confidential and at no cost. We do workshops and trainings, and we have connections to different resources. The SBDCs are like little hidden gems. So that's how you can reach the one closest to you. Our center is hosted by the City of Boulder, and we're part of a group of local, state, and national strategic partners that can help you now and through the time that you own your business. One of the groups that we work with is Downtown Longmont. They are doing some grants and had asked about doing a session on cash flow. What we found with, obviously we talk a lot about SBA loans and grants through PPP and EIDL, and we'll be talking about, updates for that next week. But there are also little bits of money here and there through different organizations, both public and private, cities, states, national organizations. And you really have to have your financials together. You need to understand your cash flow, not just for that, because you should have that pretty critical to your business, but people are having a hard time explaining the narrative and really understanding where their money is coming from and how long their runway would be. So that is why we decided to do that as our topic this week. So today is Wednesday, June 10th, and we are recording this at 10 a.m. So these points of content are pretty standard. Accounting doesn't change too much, and financial practices are pretty straight up across the board. We're going to record this session so you can sit back and relax and listen. But if you dialed in and you have questions, go ahead and put those in the chat. Everyone's on mute, but Jamie Brandis, my co-moderator, is going to be looking at the questions, and we're going to open up the live stream Q&A at the end after Brian speaks. And if you need specific help, maybe you are trying to put together your financials, you are welcome to reach out to us, and we can help you handhold a little bit if you need some extra support. So at this time, I'm going to turn it over to Brian Ormsby. He's the founder and CEO of Pantheon Solutions, and I can't thank him enough from our team at the SBDC. He's really fun to work with. He's one of our best consultants and subject matter experts for COVID, but and he's a great presenter. So I'm going to turn it over to you, Brian, and I'm going to learn some stuff too. Go ahead, Brian.
Thank you. Yeah, so today we're going to talk about calculating cash flow, and we will be talking about some different ways, some corporate and individual cash flow stuff. And so since we only have an hour, let's dive right in and get to my next slide. There we go. Okay, so this is what we're going to talk about. We're going to talk about corporate business cash flow, cash flow versus profit and loss. We'll talk about a little bit about cash flow in QuickBooks, just to show you where to get the reports if you're a QuickBooks user. And then we'll talk about, how to calculate the actual monthly or, calculate your cash flow manually in case you don't have an accounting system. A lot of people do actually keep their accounting in Excel. And then we'll go through individual cash flow models for your personal income, or if you have a very small business, the individual model actually works really well. And then the last thing we'll talk about is why cash flow is important. And then after that, we'll open the floor to grab as many questions as we can before our time is up. So first I want to talk about the difference between cash flow and profit and loss. And this is something that is relatively misunderstood, because people will look at their profit and loss or their income statement, and they'll see that they have a positive number on the bottom and assume that that means they have a positive cash flow. And it's not always true. And likewise, if you have a negative income statement, it doesn't always mean you have negative cash flow. And this is kind of important. We're seeing this lately when people have been applying for different assistance through state and county and city programs, that the programs will, ask for a balance sheet and a P&L. And if your P&L, profit and loss it is, as a negative number, that may not indicate that things are particularly bad in your company. So if you understand your cash flow, you get an opportunity in these applications normally to explain what's going on, might help your chances of getting funding for some of these programs in the future. So if your income statement or profit and loss, and you'll hear me talk about it both ways, and the terms are synonymous, is a statement of your business activity. It's a statement of revenue versus expenses. Most accounting systems are defaulted to an accrual-based accounting, meaning when I bill my client, it shows that as revenue, even though I haven't received the money from the client yet. And if the client never pays me, the revenue will sit in the books until we write it off. So in this case, let's say we bill our client $1,000 for a consulting job. Your income statement immediately shows you've made $1,000, but your cash flow shows nothing. So, and this is where the difference between cash flow and profit and loss is important to understand. So cash flow statements are statements of cash transactions. So that's what makes sense. So in a sense, cash flow is very similar to balancing your checkbook. Let's talk a little bit about where you get cash flow if you're a QuickBooks user. And if you're not a QuickBooks user, I would suggest, digging through the reports of your program, like if you have Xero or Zoom or Sage, generally a cash flow report is available. You'll just need to find it. So here I gave, kind of directions. If you're in desktop, you go to reports. Under that, highlight company and financial, and then it'll give you a little bar off to the right. And then you scroll down to statement of cash flows, which is very near the bottom of the list. In QuickBooks Online, reports are a little bit different. They come in little boxes. So you highlight reports, and then you'll go to the business overview box, and then you'll see the statement of cash flows in that box. So what that does is it immediately takes, if your books are up to date, it immediately takes the statement of cash transactions. So it looks at deposits and withdrawals and creates a statement for the date range that you put in the system for desktop or online. And like I say, it would be the same for any other accounting system. I haven't verified it, but I'm pretty sure that like Xero and Sage and them definitely have a cash flow statement. So as I said before, both QuickBooks desktop and online default to a accrual for the normal report. So if you run a profit and loss statement, there's a radio button somewhere in that statement, depending on whether you're on desktop, which is up on the top left, and online it's kind of in the middle of the screen. Will give you the opportunity to select a report. So an income statement, you could select it in cash, and it would be more closely aligned to your cash flow statement if you select a cash based income statement. But the statement of cash flows definitely will only take those items that are cash related and put it on the report. So let's talk about calculating cash flow manually. So it's pretty simple when you think about it. I mean, determine your inflow, which money coming in, subtract money went out, and the result is your cash flow. If it's a positive number, then you've earned more than you're spending. And if it's a negative number, you're spending more than you're earning. So in a business environment, I like to break cash flow up into 3 different types of activities. The reason I do this is because if your business is relatively complex, which most businesses are, even the smaller ones, you have different things going on. And you may have all 3 of these where you have, everyone has operating activities. That's how you operate from day to day. Some people have financing activities where you have stock or loans. You know, if you're a nonprofit, you have contributions. You might have investment income, and then the last one is investing activities, which I think investment income should be in there. So proceeds from sales of equities and principals on notes and money received from sales of assets. So I like to break them out into these 3 categories because when you calculate cash flow, if you have a positive number or a negative number, it really doesn't make any difference. It's important to figure out which one of these activities is contributing to the greater good, or you know, the reverse side of that is which one of these activities is the one that's dragging you down. So talk about operating activities, and let's back up just one slide here. And let's just talk about the inflow just for a minute and go through these a little bit closer. So in operating activities, we're going to talk about income from collections. So any outstanding receivables or whatever that you collect in, and your receivables, if you have any dividends or interest. So basically any money that's coming into your activity is your inflow on operating. Your financing activities are going to be sale of stock, loans, money that you borrowed, contributions again for nonprofit, and then investment income. So money's made from investments themselves. And then investing activities, which is slightly different, is proceeds from sale of equity. So if you're selling stock, you've got investors, maybe you've got an angel that's come in and you're giving them a percentage of the company. Any principal on notes, if you have notes that are paid to you, and then money received from sales of assets. So let's say you have a company vehicle, you know, every 5 years you decide you're going to trade your company vehicle or whatever, but you sell it. So, you know, the proceeds from the sale of that company vehicle before you buy the next one would be a good example of that. Okay, so now let's talk about outflows a little bit here. And in the operating activities, again, this is the things that you need to keep your business moving. So any notes to suppliers, any of your costs of goods sold, any taxes, fees, fines, interest, accounting fees, legal fees, bank fees, you know, utilities, all of those things go into your operating activities. And these are the things that, quite frankly, clearly show on your income statement. But again, your income statement may be accrual based, so it may not match up to your cash flow as well as you like. So financing activities, so money paid towards principals on debt. So if you have a loan, you know, this would be the money that goes out towards principals. Payments to reacquire equity. So if you're buying out a partner, or if you have employee ownership program where you have to constantly issue and buy shares as employees enter and exit the company, or dividends to shareholders. Those things are your financing activities outgoing. And then in your investing activities, think about anything that you paid to acquire debt, could be points, could be origination fees, things like that. Buying equity interest, and disbursements made to purchase assets. So, let's say you are a restaurant and you're buying new equipment for your kitchen. Those would probably expensive enough that would have to be considered assets. So again, kind of going back and talking about the 3-tier calculation. And so what you want to do is you want to take in the operating activities cash flow. You want to take your inflows minus your outflows, come up with a cash flow. Do the same thing for financing activities, and then do the same thing for investing activities. And if you don't have one of these 3, it's fine. Do it for the other 2. And then you would add up the sum of the 3 of those, and that would give you your overall cash flow. But the nice thing about this is that it also will tell you which one of these is performing or not performing, in which areas. So, you could have a business that is just going gangbusters and you're making money on the operating activities cash flow and doing very well, but previous financing activities is creating a negative cash flow. So the overall business has a negative cash flow. So if you know which one of these areas is your issue, then that gives you the opportunity to say, hey, well, I need to restructure my financing because we're making money, but my old loans are eating all the profit. Or when you look at these 3, and we'll talk a little bit more about this as a decision maker, you could determine whether it would be okay to bring an investor, things of these natures. So again, calculating cash flow for a business in these 3 categories helps you have information to make better business decisions later. All right, so this is moving right along, and we'll talk a little bit about individual cash flow. And so there are some businesses that are extraordinarily small, and quite frankly, whether you're in a small business or you just want to calculate cash flow for your household, which is equally important. Sometimes it's difficult to make some decisions in life. You have an old car that continually gives you trouble. It seems like all the time it's in the shop. Your Uber bills are going up because cars in the shop, but you still have to get from point A to point B. You're trying to make a decision whether this is a good time to buy another car. Can I buy a new car? Do I need to buy a used car? What's the basis of how that decision can be made? And quite frankly, cash flow is the key. So, a second, turn my phone off. So we're going to do the same thing here. We're going to calculate our monthly income. We're going to calculate our monthly expenses, and then that's going to contribute to our cash flow calculation. But for an individual cash flow, to me, this is a little bit different. And I'm going to wrap this back into the corporate one, just in case, because some people, when they do their corporate accounting, aren't 100% accrual based. So let's talk about monthly income, and then once I get through with this, then I'll talk about one of the things that we're going to do here that we may want to wrap back into our averages and our cash flow for the corporate. So we're going to talk about our after-tax salary, because it doesn't make any sense to talk about gross salary. You already know what your after-tax salary is. We're going to talk about any investment income. So if you have dividends or things like that, and interest on savings, which may be a relatively small number since most savings accounts don't pay very much right now. Any other income that you have coming in. So you could have child support, you might have alimony, you could have scholarships, you might have some federal benefits, those kind of things. So you look at everything that comes in, and then we take any other income that might come in sporadically, periodically, and average that into a monthly number. So we'll take the total annual other income and divide that by 12. Now, it may, in this case, this will give you an average. If that other income is such that you don't want to average it out because it may leave you in a negative cash flow situation for several months. For example, I know someone who gets a benefit that only comes once a year. So if you take that benefit and you average it out, it may give them the impression that they have money in a month they don't. So depending on how you do that, you may want to take that number and just pump up the cash flow in the month that you get the payment, which is okay. So then you would have kind of a monthly cash flow trend. This month I have X number of dollars left over. The month that I get the big payment, I have a lot more money left over. In this case, this is totally up to you. Averaging out will give you an idea of what you can afford if you're looking at, for example, my example, I'm buying a car, what would my monthly payment be? And averaging out would make that more palatable. But also consider that if you have one big lump sum payment that comes in from time to time, and I know some people who do get annual payments, that you have to look to make sure that maybe 2 months before that payment shows up, that you're not at a cash flow where you can't make your other expenses. So just a caution there. So then we talk about monthly expenses. Again, I always start with the ones that are most important that we tend to put at the bottom of our list, but monthly contributed to savings and investments are the first two. These are the things that you should be doing first, making sure that you pay yourself before you pay someone else. Housing expenses, other bills, food and transportation, loans, children's school expenses, clothing and recreation, average of other expenses. So now I always have another kind of cautionary tale when it comes to expenses, because everyone can put a budget together and it looks great on paper. So it really does make sense when you start looking at certain bills and clothing, recreation, gifts, food, transportation, children. These are easy to budget and say, oh, I'm going to spend $100 on clothing. But it doesn't work that way most of the time. So this is a really good opportunity to pull out receipts in your checkbook and your credit cards and find out, what did you really spend? What is my average? I was shocked to find after COVID-19 hit and we were basically sequestered to stay home, and my wife and I generally go out several times a week, how much money I was spending on food. I really never paid any attention because it was part of my normal routine. But when it didn't become part of my normal routine, all of a sudden there was money in my checkbook that I didn't expect. And it was all because I wasn't spending, $50 or $100 every time I went out to eat, which, was often. So when you look at those bills, one at a time, none of them are shocking, but you add that up over a month's time or even a year's time and then divide it by 12, this is a really good time to go in and find out, what am I really spending when I go to the grocery store? What am I really spending on restaurants? What's my transportation? So, because I think, well, I fill up my tank of gas once a week and that's $30. That's my transportation expense. But you also have to go in and say, hey, I buy tires like once every 2 years. I get an oil change every 3 months. So it's really a good opportunity here when you're doing expenses to go and dig into where you spend that money credit cards, debit cards, things like that, find out what the actual expenses are and come up with a true number. And that will help you get more reliable data. So then we take the income minus the expenses, that's your cash flow. So before I go on to the next slide, I want to talk about the averaging thing a little bit, because as I said before, averaging is kind of one of the most common methods of taking other income or other expenses and pushing them into a monthly cash flow. But again, you have to be careful that if you have a sum, you may want to include it only in the month that you get it. Now, wrapping that back to the corporate tax flow, when I do a corporate tax flow, I actually sit down and I not only go back and do last year's cash flow on a monthly basis, but I forecast next year's on a monthly basis. So I look at my revenue and I say, well, how much money do I think I'm going to make this month, and now next month, and the next month? Am I going to have a big deal? So if you're a catering business, you may have months that are much slower than others. When you get around time where weddings and parties and stuff like that, then your cash flow may be inflow may be much higher in those months. So it's important sometimes to look at the month to month, because that may be how your business is structured. If you just average from month to month, if your business is very stable and every month is very similar to the last month, then the averaging method is something that I would definitely recommend. But quite frankly, I think that's more unusual than it is usual for a business to be stable that way. So I would definitely look at my cash flow on a month-to-month basis and try to figure out what my trends are. What is my typical April? What is my typical May? What's my typical September? Because I think that's more likely for a business to have periods of time in the year that are higher or lower than other periods of time. So that was kind of my segue into this slide, which is the second to last slide, by the way. So we're going to have time for questions here. Is why is cash flow important? And we've talked a little bit as we go through about aids in decision making. If you know that you have negative cash flow, then you have decisions that you have to make. Those ones maybe are hard decisions, but it's easy to come to that decision that, oh, I have to do something. I've got to figure out how to make more revenue. I've got to figure out how to restructure my debt. I have to figure out how to get some more capital. So these things, so when your cash flow is negative, knowing that you have to make a decision is obvious. When your cash flow is positive, making decisions there can be actually a lot more difficult, because you have to decide, well, am I happy with the status quo? Is this the cash flow that I want? Is my business doing what it's supposed to be doing? Is this the direction that I want to be? But I have more money. Should I invest it in doing something else? Can I make a bigger and better world? Is this the right mousetrap, right? So cash flow gives you the ability to make those decisions, or forces you to make decisions. And if you don't know what your cash flow is, then you could be making decisions that end up putting you in a forced cash flow decision. And quite frankly, if you don't analyze your cash flow, if you know that your cash flow is negative, but you don't know why, then whatever decision you make is likely to make it worse. So you need to go in and look at the aspects of your cash flow. What is making me negative? So now I know what needs to be fixed, or what else can I do? Maybe what can I do in operations to fix my negative cash flow in financing? If I can somehow increase my business, that would make it all better. So the cash flow is that checkup, right? That's a checkup of your operations, and I use the term operations here, but I mean operations or investment and financing. It's a checkup of those areas of your business to determine, am I doing well? Provides feedback from previous decisions. So you make a decision, and I always say, if you can make a decision in business that you can somehow rescind later, it would be great. Most of the time you can't. But if you are tracking your cash flow and then you make a decision and all of a sudden your cash flow is doing something adverse that you did not expect, you can pinpoint back to the decision that you made that caused that to happen. Sometimes if you're not tracking these things, it's hard to tell what decision, what did we do? Why did this happen? So if you're tracking cash flow on a regular basis, and then you're tracking your decision tree on a regular basis, you can say, boom, wow, at that stop, that waypoint, if you're a pilot, we went the wrong direction. And so that, to me, is another really important thing about cash flow. And the last thing with cash flow, to me, is it gives you direction. It should help you set the lanes in which you operate. And as we know, when we're going down the highway, lane discipline is very important. Lane discipline is also very important when you're running your business. If you can stay in your lane and you can keep doing what you do well and not get diverted on some kind of detour, you're going to make good time getting to where you're going, which in business means you're probably going to be profitable. Okay, so oops, went backwards. This is about me, so we don't need to read that. And so the next thing is questions. So I'm going to turn it back over to Jamie, and we will.
Awesome. Well, thank you so much, Brian. I think this is really helpful. I know it's a topic that a lot of people have some issues with, and especially during this time, cash flow is really difficult. So thank you for spending the time to explain some of this, and I hope this has been helpful for the people listening in today. So I do have a few questions that I'd love to get to. So one is, how do you project future cash flow?
Oh yeah, this is really, really good question and super hard. Okay, so now I think somewhere on the slide presentation you'll be able to get that from SBDC. My email is on there. It's brian@pantheonco.com. And when it comes to projecting cash flow, I do have a model that I can share with you. So if you want to email me, I can send it to you. It is quite difficult. So to project cash flow, you really have to have a tab, and I create a spreadsheet with tabs for everything. You have a tab that sits down that just projects revenue. So you want to see, when am I going to make money, from what source, and what month do I believe that I'll actually receive the payment? Not when am I going to invoice, but when am I going to receive the payment? What's my employee count going to be? How many hours do I need everyone? And we need to scatter that over the entire year to be able to look at that payroll cost, because that's probably, for most business, your number one cost. Then we go through and we look at materials. So I typically, when it comes to materials and other supplies, I will go back and look at my history and then determine line by line on everything on my history, from office supplies to unemployment, workman's comp. I mean, you pick a category and determine, okay, am I going to need more of that in the next 12 months, the same or less, and why? And in the comments on the right-hand side of my spreadsheet, I'm going to put the notes that tell me, why did I come to that conclusion? So this is a long process of forecasting. It should take someone, even in a small business, and I say, let's say that you have a mobile dog wash. You should probably spend several hours sitting down, going through, here's all my expenses from last year, here's where I'm going this year, and trying to figure out how is this going to land. So part of it is a guess, which makes it really hard. But the other part is going through that guess with as much education as you have, because no one knows your business like you do, and figuring out where do I think this is going to land, and do it month by month over the next 12 months.
Great, thank you, Brian. So a couple other things. So someone is a sole proprietor. So how do drawings affect their financial statement?
Did you say draws?
Yeah.
Okay. Well, so in a sense, your draws, and this is where it's really important to understand that your profit and loss and your cash flow are disconnected, because a draw is not an expense on your profit and loss, but it is a hit to your cash flow. So when you're a sole proprietor, you look at your net gain or loss and on your income statement, and that may have nothing to do with what you have in your bank account, because you're taking draws which show up on your balance sheet. So realistically, the way, and if we'll use IRS terminology, if the IRS says that you go through the course of your business over the course of the entire year, you figure out what your net profit and loss is, divide that by 12, and that should be your draws. That's not how it works, but that's kind of realistically what happens, right? So, and how the IRS calculates it on an annual basis. So if your business, I'll take a number that's really simple. Let's say your business makes a net profit of $60,000 a year, divide that by 12, pay yourself $5,000 a month, really simple. However, your cash flow will basically be zero at the end of every month, because your net profit is $60,000 and you're burning down $60,000 in the fashion of $5,000 a month. But your income statement will show $60,000 at the end of the year that got pushed to draws. So that's how draws work in a sense. And again, why it's really important to not look at your income statement for a picture of what your cash flow is, especially if you're sole proprietor.
Okay, so this person owns an event center, money paid today for events in a year. They also do manufacturing, so they need to do cost of goods sold, etc. Their bookkeeper does GAAP accounting, but after reading the book, Profit First, they've been almost redoing all of their accounting to better meet their needs. And so they're not sure which way would give them the best information that they need.
Oh, that's a really good point. So, well, GAAP-based accounting puts things in by how costs are incurred. So what that means is that when you invoice a client, it goes in let me back up just a little bit. Let's say you invoice for an event that happens on July 4th. Then technically that invoice is a July 4th accrual, because you're doing a Independence Day event. That's the day it happened. Now, that may be a net 45 pay, which means you don't get paid until August 19th. So cash would be affected in August. Your accrual-based or GAAP-based accounting would show the income in the month in which it happens. So depending on which accounting system you're using, I'm not a proponent of trying to switch your accounting to a cash-based accounting system, because most accounting system programs will allow you to run all your reports in cash. So you keep doing it in accrual, because that being GAAP is important. Being GAAP is important, knowing that your books are being executed correctly, but then being able to run reports in cash give you the information that you need. So if your accounting system doesn't give you that flexibility, I would be surprised. But if it doesn't, then I would look for one that does. But I would not change my books strictly to a cash-based system, because on the manufacturing side, that really probably doesn't make any sense at all. We can have a longer conversation about that if you want to talk to me offline.
Great, thank you. I did just want to note that Brian is one of our specialists that does consulting with us. So if you want to reach out to the Boulder SBDC, you can request consulting with us, and then we can get you connected to Brian as well. So you don't have to email him directly, so that we get you in our system. So let's see, this person, they say they have a speakers bureau. Same thing, they often get paid 6 to 12 months in advance with a 50% deposit, and then 12 months later they get the balance. So they're wondering if that would be the same case as what you just said for the previous question.
Yeah, I mean, so, this is, so normally those setups are cash flow positive for you, because you get money up front to cover expenses and keep your cash flow moving. So in a sense, that prepayment is prepaid income, and that's really good for your cash flow, but it has nothing to do with how you recognize revenue on your income statement. Now, when you're doing this kind of work over a period of time, then recognizing revenue has its own section in GAAP. But in short, recognizing revenue is the monies that you would expect to collect during a particular period for the work that happened during that period. Now, it's important that the expectation to collect is a big piece on this. So since they've already prepaid you, during the first few months, you can recognize the prepaid revenue in those months until you burn it down to zero. If it's a good client, you know they're going to continue to pay you, then you would continue to recognize revenue even if they owe you money. But your cash would only show up when they pay you. And then your income statement would be recognizing revenue as you put forth the effort and recognizing based on that level of effort. So that, for most companies, is the cost of goods sold and payroll and associated costs, and some expectation of profit percentage on top of that is what you would recognize as a revenue, and generally you do that monthly.
Great. So this person has a nonprofit. They're wondering if there are any benefits to being a nonprofit related to cash flow.
No, I don't know that there's any particular benefits to cash flow in terms of profit, nonprofit. Even though you're a nonprofit, it is important to have money. So it's, in your case, there's probably a few different things in terms of inflows of how you get your money that help you with cash flow. But I would think it's just important for a nonprofit to understand what their cash flow is, because you need to know whether you need to if it's investors or contributors or sales, regardless of the situation, knowing your cash flow would be the same as a for-profit company.
Great. How many months of reserves would you recommend that people have in their bank account?
Well, a standard answer is 6 months, but that's really a wild guess, rounding, because the person who says that doesn't understand your business. And so the answer to the question really has to do with analyzing your business and determining, what can you afford, what can you expect. So when you do that, as a small business owner, you can't just look at your business. You have to look at your business, then you have to look at your household and everything that goes on around you to determine what is the runway that I need if all stops tomorrow. If you know, and I used mobile dog wash as an example earlier. Let's say I get in a car accident, I break my hip, I can't wash a dog. How long can I recover making zero money and save my business and my house? Because even though we make corporate elections, LLC elections, whatever, to try to save our house from our business liabilities and so on and so forth, regardless of what that election is, we're all tied together. If one fails, the other is likely to fail as well. So rather than me just spewing out a number and saying 6 months, which has been the standard answer as long as I can remember, look at your personal situation. What do you have in place? For example, if you had loss of income, do you have loss of income coverage? If you know, what are the things that you have in place? What's your personal savings look like? What is the amount of savings in your business account look like? What are you willing to do? If you had a situation where your business was not making money for a period of time, could you close the doors and go work for somebody else and still be okay? Is that, you know, so there's so many things that get worked into that situation, and you really need to analyze a kind of a problem solution and look at worst case scenario, what's the most runway I need, and then a normal case scenario. I mean, we can look at COVID as maybe the new normal of how do we estimate how much runway do we need? I think a lot of people are learning that through COVID right now. So again, there's no easy answer. 6 months is the standard answer, but every business, every personal situation, every type of insurance or whatever that you have going on and the type of things that could affect your business makes it different. So to, you know, look at the global picture and then make a decision.
Thank you. So this person applied for a grant and didn't get it. Do you know if there are a couple of things that specifically would have been red flags that the reviewer may have seen?
Yeah, no, I've been on some of those review groups. I've talked to several reviewers about what stands out and what doesn't. Number one that I've seen in every review is, does the company or the person who is applying for a grant convey that they understand their situation, that they have a forward-looking plan? So that's number one. That is, you know, the one that gets packages thrown out the quickest, is that in their application, it doesn't seem like they understand their own finances. They don't seem to have a plan going forward. They don't understand their cash flow. Number two would be, unfortunately, financials that are on either end of the spectrum. In other words, you're applying for money, but your financials look so good that the reviewer says there's probably somebody who needs that money more. Or you're applying for money and your financials look so bad that they're afraid they're going to give you money and you will still fail, and they would rather give it to someone who has a better chance of success. So when you look at your financials, and this is why I think the cash flow part is so important, if you have a negative net, which is quite common in small businesses, as a matter of fact, that's what we all work for. Every year we want to make it where we don't pay any taxes, right? So we're trying to get our net as close to zero as possible. So when we go to apply for a loan and they see a negative net and someone says, well, that company doesn't look like they're very stable, we need to kick them out. But you didn't provide any response to why the negative net is there. What is your business plan? this year we had a negative net because we're investing in our future. So you have to sell the case, and cash flow is a good way to sell the case, but language real words describing your business in the direction you're going and why you need the money and where that's going to take you is what I'm seeing in these review packages is the ones that are falling by the wayside.
I think that's really helpful, as so many people are applying for funding right now to understand, what reviewers are looking for. And so thank you for answering that question. So then the other question would be, let's see. Sorry, trying to get through these. I feel like there was one that was related. What do you think banks are looking for the most with financial statements? Does it look better to have records in QuickBooks, or is it okay to use their own spreadsheets to track? What would be your suggestion with banks?
That's a good question. I don't think a bank particularly cares whether you go out and spend money for an accounting program or have your act together in, for example, Excel. I know some relatively large businesses that still use Excel, so it's not uncommon. The reality is that you don't give your bank your QuickBooks file. You give them reports. You're not going to give the bank your Excel file. You're going to give them reports. So whether you're using a made by yourself accounting system, or you're using QuickBooks or Xero, what you want to give your bank is professional looking reports. So what does that mean? I mean, you can go online and look at what an income statement looks like, and then take the information from your Excel spreadsheet and create an income statement that looks good if that's what they're asking for. Create a balance sheet that clearly defines all of your assets and your liabilities. What banks are looking for is, and I assume we're talking about a loan, but what banks are looking for here is, can you survive the process of this new debt? So however you convey that information, it needs to be professionally presented, and it needs to make your case that if you take on this new loan and this new payment per month, that you're still going to be healthy and you're still going to make that payment. All a bank wants is to see you succeed, but not at their own detriment. So they're going to make sure that you make money. That you're making money to pay the loan, and they make money to give you the loan, and that it's not a lose-lose. They want it to be a win-win. Unfortunately, sometimes it makes you feel like the only time that a bank will loan you money is when you don't need it. But quite frankly, it's about presentation. You go in there like you're selling a product, but that product is you.
Great, thank you. So this person thought they were a profitable business, but they now realize that they were really losing more money than bringing in. So is it better for them to focus on reducing costs or increasing prices, or what would you recommend in that situation?
Well, I'm, being an old accountant, I'm a cost cutter by nature, but I don't think that's the answer to every question. So I think you need to go in and look at what costs can we reduce? How can we be as efficient as possible? Think about the difference between Kmart, Sears, and Walmart. Walmart is touted as the most efficient company in the world at what they do, and they're making money hand over fist in that industry, where the other two examples I gave are touted as being extraordinarily inefficient, and neither one of them can make money, and by the end of the year, probably neither one of them will exist anymore. I mean, Kmart I don't think has existed in a while, although Kmart and Sears at some point combined, I think became just Sears. But digressing into that, efficiency is very important, but that's only one part of the puzzle. You still have to look at all aspects of your business, determine what parts are profitable, what parts are not profitable, determine whether you need to make hard decisions on cutting those. What can I do when I segment this out to make each segment profitable? If I've got a segment of my business that is losing, maybe I can fix the problem by cutting that segment out. Maybe instead of staying in my lane, I diverged off on something that I'm not really an expert in. And now I'm trying to do something that, you know, I like it, it's fun, but it's not making me any money. So you have to look at the whole business, and not knowing what business you're talking about, it's hard for me to encapsulate that, but you have to look at all aspects of the business. You have to be efficient on your costs. Look at only those things that are making you money. Do you have different products that one's a loser, that one's a winner, and go through it one by one and break it down. And it's difficult. This is the hardest thing you probably ever do in your life next to raising kids.
Great. Thank you so much, Brian. It looks like we've pretty much gone through all the questions, and we're coming right up on time. So there's good timing there. Let's see here. I just wanted to mention again that we do offer consulting, and I know we have people all across the state here. So to find your local SBDC, there are 15 centers. It's coloradosbdc.org. And then with the Boulder Center, it's bouldersbdc.com. We are going to send out a follow-up email tomorrow with a recording of today's presentation. We'll also include Brian's slides with that. So again, feel free to reach out if you do want to connect with Brian directly. I know one person was asking if we have an updated list of grants available right now. So I will say those things are changing constantly. Different organizations are coming out with new grants. So we are trying to keep that updated, especially on the state website, as I mentioned, coloradosbdc.org. But we do share those as they come out as well. The other thing I was going to mention that Susie said at the beginning is that we are going to do another webinar next week on the PPP and EIDL loans as new changes are coming out. Brian's been really great about keeping on top of that, so we're going to include him in next week's presentation as well. Let's see, Susie, do you have anything else to add?
No, I think you nailed it. And Brian, great answers. I thought it was awesome, and I really could have used you when I had my business. Yeah, for sure. I think some of us tend to lean towards, if we're not in the financial mind, even, like are more creative, like we go towards leaning on an accountant or a CPA or a bookkeeper. But one of the things I learned most particularly is you do need to control your destiny and have a handle on that runway and where you're going. So and Brian's a huge component of that by pushing those things. So anyway, thanks so much, and let us know if we can help.
Thanks everyone, and thank you, Brian, for presenting today.
Thanks.
Thanks,
Bye.
Brian.